Yes.
Okay. So this is types of ratio. When we say types of ratio, it means like there are different categories of ratio, uh, different purpose, different categories with different purpose. So the first one here you can see is liquidity ratio. Now, one by one, we are going to discuss all these types of ratio. So I think you have written both of these.
Yes, sir. Sir,
Okay.
once
Now,
we see
yes.
which where I wrote. Yes, sir, I wrote types of ratio.
Okay. So the first one is liquidity ratio. You can see here, liquidity means ability of firm to meet its current obligation, that is short-term liabilities. Liquidity ratio are computed to evaluate the ability of firm to meet its current liabilities. Now, first of all, that when we say current liabilities, it means trade payables, short-term borrowing, all these things, other current liabilities. So if a company have enough cash or bank balance or uh, the assets which can be converted in cash very easily, then only it has a better liquidity position. Because if someone ask for their money immediately, let's say we have purchased goods on credit basis and someone is asking that, okay, you should give me my money within 2 days. In that case, if you have enough cash, bank balance, or the assets which can be easily converted in cash, then only you will able to pay these liabilities. Yes or no?
Yes,
So
sir.
that's why it is called liquidity, means ability of firm to meet its current obligation, short-term liabilities. So there are two: liquidity ratio, current ratio, and liquid ratio. So these two ratio we have to discuss under liquidity ratio. Okay. So liquidity ratio is different. Liquid ratio is different. Okay. Don't get confused. Liquid ratio is part of liquidity ratio.
Yes, sir.
Please write.
All right.
Done.
Yes, sir. Done.
So the first ratio you can see here is current one, the current ratio.
Yes, sir.
So here it is, current ratio. Current ratio shows the relationship between current assets and current liabilities. It shows the ability of business to meet its short-term obligation. Means like It is the relationship between current assets and current liabilities. You know what is current assets and current liabilities?
Yes, sir.
Yes, the liability which is payable within 12 months is current liabilities, and
Give me a minute. This intro.
the assets which can be converted in cash within 12 months is current assets. Okay.
Yes, sir.
Okay. So, the relation between current assets and current liabilities is called current ratio. Okay. You can see the formula also. It is current assets divided by current liabilities. Now, the ideal current ratio for a business is 2 is to 1. Means if you have a current liabilities of 1 lakh, then in your company, obviously, the current assets should be 2 lakh. Current liability 1 lakh, current assets 2 lakh. Then it is called ideal ratio, means the current assets should be double of the current liabilities. Okay,
Yes, sir.
please write this. Then we will write the current assets and current uh,
All right.
liabilities.
Yes. Yes, sir. Done.
Okay, so now after that, in this formula, there are two components: current assets, current liabilities. You already know that what comes in current assets and what is included in current liabilities. You have studied that in the financial statement, yes?
Yes, sir.
Can you tell me what are the items included in current assets?
So like plant machinery,
Current assets.
uh, so cash,
You don't remember the format now. You told me that you remember the format.
format for current assets.
Format of financial statement balance sheet.
Oh, you said, oh, okay. I thought you were asking like the examples.
Current
So
assets.
for uh, so for the balance sheet, like first is the current
Non-current.
asset. Under
Not
that is
talking about non-current. I'm talking about current assets
so like
in balance sheet.
inventories and all, right?
Yes.
Short-term loan, that one. It's a current investment, inventories, trade receivable, other current assets, short-term loans, and cash equivalents also.
Current liabilities.
So current liabilities, um, so short-term borrowings, short-term provisions, trade payables, other current liabilities.
Yes. So you can see here that here current assets includes current investment, inventories, trade receivable, cash and cash equivalent, short-term loan and advances, and other current assets. But there is some changes. Okay, so that's why I asked you that if you remember all the items. So these are the items. Now you can see in inventories, it is written excluding loose tools, stores, spares. At the time of balance sheet, I told you that inventories includes like raw material, finished goods, work in progress, loose tools, stores, spares. But uh, in the calculation of ratio, you don't have to include loose tools, stores, spares. Okay.
Yes, sir.
Also, in like other current assets, I've not written other current assets. So instead of that, because in other current assets, we have to consider only three: advance tax, accrued income, prepaid expenses. There are many, there are some more than this, but we have to consider only these three. That's why I have written only three. Okay. In the same way, like in current liabilities, there is no changes, everything is same as the format. So please write this.
All right.
What is that here?
Tell me when you have completed. Done.
Almost. Yes, sir. Done.
Just one minute. Okay, so now after this, there is second ratio called liquid ratio. It is also related to this, but liquid ratio is better measurement of liquidity. Okay, because in current ratio, there are certain items which is not like very liquid. When we talk about inventory that you have purchased in your stock, it is. So when it will be sold, then only it will be converted in cash. It is not up to you that you can convert it into cash. Yes.
Right, sir.
Like if you have sold goods to someone, you can ask them that give me my money. Okay, so
Yes.
it is like in your hands, but the stock you have, you cannot call the customer and say them that purchase my goods. You cannot say that. So it is not up to you that you can convert your inventory in cash like in very short period of time. So that's why inventory is not included in liquid assets. Also, prepaid expenses, there is one more item, prepaid expenses. Prepaid expenses means that you have paid advance for any expenses. Okay, so let's say there is a labor that is working for you and you have paid money in advance so that he will work for you in future. Now, whenever you pay money in advance, you there is a purpose that they will work for you. So you cannot ask them to refund the money whenever you need. You can ask them to work for you, complete your work faster, but not ask your money back. Huh, yes, if they refuse to work for you, then you can ask your money back. But until then, you cannot ask your money back. You have to like uh, tell them to work faster, complete the work before time or on time. So that is why inventory and prepaid expenses, which is included in current asset, should be removed for better liquidity position. So that is happening in liquid ratio. You can say see here, liquid ratio is more stringent measure of liquidity, better measure. It shows the relation between liquid assets and current liabilities. Now, liquid asset is almost same as current assets, but little bit difference. Okay, we will discuss that. It shows the ability of a business to pay its liability in a very short time period. Very short, not short. Very short means within 3 months, you can say. So we only include those assets which can be converted in cash within 3 4 months, very short period of time, not whole year. In current assets, we have included all the assets which can be converted in cash in 12 months. But here we are including only those assets which can be converted in cash within 3 4 months. Okay.
Yes, sir.
So you can see the formula, liquid ratio equals to liquid assets divided by current liabilities. There was in current ratio, it was current assets divided by current liabilities, but here liquid assets divided by current liabilities. So liabilities remain same, it is current liability, but asset will change. Ideal liquid ratio of a business is 1 is to 1. Okay, so it is better, 1 is to 1. Now the formula for liquid assets, when someone asks you what is liquid assets, so liquid asset include all those items that is included in current assets except two. So you can say liquid assets equals to current assets minus inventories minus prepaid expenses. If you remove these two from current assets, it will become liquid assets. Is that clear?
Yes, sir.
Okay, any question?
Sir, can you explain the like I'm getting confused between liquidity and the liquid ratio.
Liquidity means ability of a firm to pay. Actually, liquidity is a measurement. Okay.
Yes.
And liquid ratio is a method of that measurement. Okay. If I ask you that, how can you measure the height? Okay. So you will use a tape to measure it. Yes or no? So using the tape is the method, and the height, when you are asking, it is like, so it is the requirement. So liquidity means, liquidity tell you about the situation, the company position to pay its short term liabilities. So there are two measurement of liquidity. It is, liquidity is ability of firm, and current ratio and liquid ratio is a method to measure that.
Yes, sir.
Okay. Liquidity means ability of firm to meet its current obligation.
Yes, sir.
Okay. Ratio is a measure, a method, a technique. That is the difference.
Okay, sir.
Please write this. I'm sharing a question. Tell me when it is complete.
Yes.
Done?
Done.
This also, please write this. Okay, now you can see the question here. From the following, compute current ratio. The first question. So trade receivable is given in the question 1,80,000, prepaid expenses 40,000, cash and cash equivalent 50,000, marketable securities, land and building, bills payable, creditors, debenture, inventories, expenses payable. All these are given. Now, first of all, to calculate current ratio, what we need? Current assets and current liabilities. Yes,
Yes.
you have completed writing process and you didn't tell me. You were
I
sitting idle.
already finished like as soon as you were scrolling.
So trade receivable 1,80,000. It is question number one. So we will write current assets equals to it is trade receivable. So 1,80,000 plus prepaid expenses 40,000 plus cash and cash equivalent 50,000 plus marketable securities 50,000. Land and building is non-current assets. It will not be included. Bills payable, it is current liabilities. Creditors, current liabilities. Debenture, non-current liabilities. It will also not be included. Inventories, 80,000. So plus 80,000. 1,80,000 plus 40, 220, 320, 4 lakh. It is 4 lakh, the current assets. Now, after that, we will calculate current liabilities. So it is current liabilities. So current liabilities is mm, there is bills payable and creditors and expenses payable. So 20,000 plus 1 lakh plus 80,000. So total is 2 lakh. Now current ratio, you always write formula